If you think tax season is something you should start worrying about in January, you're already behind, because 2026 is shaping up to be the most confusing tax season we've had in years. And the businesses that prepare now are the ones that are going to win. I'm Trevor Densmore, founder of TJD Accounting Tax. We help business owners clean up their financials, reduce their tax liability, and build a strategy that keeps more money in their pockets instead of sending it to the IRS. And today, I'm breaking down what's actually changing heading into 2026, how these changes affect you, and what you need to do right now before December 31st to get ahead of it all. Let's get into it. First, IRS enforcement is getting stronger. The IRS is now using AI to match your books, your payroll, your 1099s, your merchant process total, and your tax return. If something doesn't match, even by a little, you get flagged. This is going to hit cash-based businesses, contractor-heavy businesses, and S-Corps especially hard. Second, reasonable compensation requirements for S-Corp owners are tighter. Your salary has to align with what someone will be paid to do your actual job. If you're underpaying yourself just to avoid payroll taxes or overpaying yourself without a clear reason, the IRS may reclassify income or hit you with penalties. Third, bonus depreciation is still at 100% for 2025. You can fully deduct qualifying equipment in the year you buy it, but to take advantage of that, your books need to reflect when you bought it, what you bought, and how it should be categorized. If your books are messy, your deduction might not be allowed. Fourth, multi-state tax rules are tightening. States are sharing data at a level they never had before. So if you sell in multiple states or move materials across state lines, construction, e-commerce, service-based businesses, you need to be prepared for stricter compliance. Fifth, W-2, 1099, and payroll penalties are going up. If you file late or file incorrectly or forget to issue a 1099, the penalties in 2026 are higher than ever before. 2026 is not the year to wing it. It's the year to set up clean systems now, so tax season doesn't punch you in the face later. Here's what you should be doing now. First, if you don't know your numbers going into December, you can't plan for January, and tax season becomes chaos. Get your books fully caught up before December 31st. That means reconciling accounts, categorizing expenses, correcting errors, matching payroll, merchant accounts, and bank accounts. Clean books now means a clean tax season later. 2, you haven't reviewed your entity structure. Your business may have outgrown the structure you set up years ago. My recommendation, review whether staying LLC, electing S-Corp, or adjusting partnership allocation will minimize your 2026 tax liability. A lot of businesses hit new revenue levels this year and don't realize they're in the wrong structure. 3, you haven't evaluated your payroll for 2025 compliance. This is huge for S-Corp. If your compensation is off, the IRS is watching. Run a year-end payroll review. If your salary doesn't match industry expectations, adjust it on your final payroll run of the year. Issue 4, you haven't adjusted for sales tax or multi-state rules. If you expanded sales, hired remote employees, or worked across state lines, you may owe sales or use tax without knowing it. Check each state's threshold and see where you have nexus. Correct it before penalties hit in 2026. 5, you haven't planned for equipment purchases. If you're going to buy equipment in Q1 anyway, you may want to push it into December to take advantage of full bonus depreciation. Review your equipment plans and decide if buying now creates meaningful tax savings. 6, you haven't run a year-end cash flow projection. A lot of tax surprises happen because business owners don't forecast. Project your cash flow from now through March. This tells you what you can buy, what you should defer, and how much you should expect to owe. 7, you haven't held a year-end strategy meeting. Most business owners don't step back to look at their year until it's too late. I recommend sitting down and reviewing revenue, profit, cash flow, spending, owner's compensation, taxes, hiring plans, capital purchases, and goals for 2026. This gives you clarity and helps you avoid mistakes in the new year. If you're still watching, you already understand. 2026 is not the year to take chances. Businesses aren't getting audited because they're doing something wrong. They're getting audited because the IRS technology finally caught up to the way business operate. And the ones who prepare early are the ones who avoid headache, avoid penalties, and keep more money. At TJD Accounting and Tax, we help business owners clean up their books, plan for tax changes, and walk into the new year with clarity and confidence. If you want to make sure you're ready for 2026 before the deadline hits, click the link in the bio and book a free year-end tax strategy call. We'll look at your numbers, show you what moves you can still make before December 31st, and get you prepared for the new tax season before everyone else is scrambling. Let's make 2026 the year your business runs smarter, not harder.